Hello and welcome to Asset TV. I'm Erin Real, and today I'm sitting down with Stephen Schoffstall, Director of ETF Product Management at Sprott Asset Management. Stephen, thank you so much for being here. And I want to jump right in. Sprott recently launched active ETFs that are focusing on active gold and silver miner ETFs. This is a new space, lots to talk about. So what can you tell us about the fund's investment objectives?
Yeah, so it is an active-based strategy, ticker GBUG or GBUG, as we refer to it as. Given that it is active, it is kind of the first of its kind in the space and focused specifically on gold and silver miners. So what we do is our portfolio team actually screens for those miners that are expected to outperform over the longer term. So we're looking at miners, exploration companies, development, streaming, and royalty companies. They're going to make up a vast majority of the index as they relate to gold and silver. We also do have the ability to invest in other precious metals like platinum and palladium, though that's not expected to be a significant portion of the portfolio. Well, that's where we really rely on our investment team's expertise. So our investment team has over a century of experience in the mining space, so very well versed in it. They've cultivated deep relationships across the industry and each year conduct over 200 management team meetings. In addition, we have an economic geologist on the team who actually does up to 30 site visits a year. And with that, they actually have a number of models that they run. They're looking at things like company financials, debt burdens, but they also do conduct sensitivity analysis. So they're looking at things like how the price of gold or silver could impact a company's bottom line, their capital structure, and other metrics around that as well.
Very interesting. And Sprott has over 4 decades of a specialized experience, like you mentioned. You know, this team built out with people who you wouldn't normally expect on an investment team, and it's in the metals and mining investment space. So how is this experience used in managing GBUG, as you mentioned?
Yeah, and it really does come back down to those relationships that they've built over time. So those management meetings, really getting to understand the management structure, the capabilities of management teams. And when they do these site visits, they're not just walking through mines, they're actually going through and meeting with different levels of management within each individual mine site they visit. And they're not just limiting themselves to US or Canadian mines, even though that's where a lot of the exposure is. They go to some pretty far-flung areas like Papua New Guinea and South Africa and other countries as well.
So gold has set records over the past year, silver as well. We're really seeing incredible movement there. So what are some of the reasons driving these higher prices?
It really comes down to the fundamentals. So when you look at gold, for example, over the last 3 years or so, we've seen a lot of central bank buying, which has really been supportive of higher gold prices. Each of the last 3 years, we've actually seen that go across 1,000 tons a year. If you were to go back to 12 prior years, that's more than twice what the annual purchasing was on average over each of those years. So central bank buying's definitely been key. But when you start looking past where the investment flow is going and start looking at the underlying fundamentals, you start to see that the mines that are out there, the ore grades are declining somewhat. The miners are actually investing records amounts trying to find new quality deposits. That's becoming more and more scarce. That's something that we hear across the commodity space. And what that's really doing is, if we start looking down the road, the next 3 to 5 years or even longer than that, we think that we're going to have to see higher gold prices to justify the production that we're seeing coming out of the ground. As far as the silver side, it's also fundamentally driven. It does tend to lag gold somewhat. Usually what happens is gold moves first, and then we get silver that kind of catches up and usually surpasses gold historically. But from silver's perspective, a lot of it comes down to what we're seeing on the energy transition and artificial intelligence and technology space. For silver in particular, it's actually been in market supply deficits for each of the last 6 years. So not enough silver coming out of the ground to meet demand, which is an issue that the industry is going to have to cope with over the long run. And kind of one last difference between silver miners and what we see with gold is much of what we see from silver mining, it's actually a byproduct. So about 72% of all silver that's mined comes out either from companies that are mining copper or zinc or lead or some other material. So higher silver prices don't necessarily correlate to more silver production because each mine's set up differently. And I think it's that difference in how operationally complex these companies are that really makes an active strategy appealing.
That's really interesting. So why might an investor want to add exposure to silver or gold to their portfolio right now? Why now as opposed to another time?
Yeah, so they both function as precious metals. So silver's has some duality where it is precious and industrial metal, but it does have a lot of those precious metals characteristics. And with that, you tend to see both silver and gold outperform in periods where you start to see economic uncertainty, falling interest rates, geopolitical risk, a lot of the things we're seeing now, volatility in the market, inflation. So it does add a potential for portfolio protection. We also see some low to moderate correlations relative to other asset classes, whether it's the S&P 500, broader bond market, and then actually negative correlation to the US dollar. So there's that degree of protection within the portfolio, or an insurance policy, as some people refer to it as, that's appealing to investors.
So how might one go about adding gold to their portfolio? There's a number of ways. You can have physical gold, you can have passive funds, there's active ETFs. So how does one do this?
Yeah, so the way we view those is they're very much complementary of each other. So the physical component, we tend to advocate for most investors that physical silver or gold component might be a good way to add some differentiating factors within our portfolio, because they do act different than equities, whereas equities could potentially get caught up in a broader market sell-off. And then it really comes down to, on the equity side, active or passive, which is the key question there. We don't really have a view one way or another. It really comes down to investor interest. So investors that are comfortable taking on that active manager risk might want to look at something like GBUG that seeks to outperform. And one of the things that we see, particularly in gold miners, given that they're very operationally complex, there's a large dispersion in returns that we see. If we look at the last 5 years, the top performers outperform the bottom performer by an average of about 170%. So very significant opportunities for identifying those undervalued companies and then investing in them and attempting to capture relative value. From the passive side, investors that want to get exposure to the metal space through equities, which tend to provide a degree of leverage, can be a way to go for an investor that doesn't necessarily want to take on that active exposure.
Makes a lot of sense. Is there anything else you'd like to add on this subject?
Yeah, I think just one thing that really sticks out about GBUG is, and important for investors to know, that it is very much at its core, it's a value and contrarian play. So the portfolio managers are taking their expertise and looking to find those companies that over the longer term are expected to outperform. It doesn't have a short-term bias. They're looking at typically investments to hold for 3 to 5 years, though that can change. But they do have a long-term mindset, and that's really the crux of GBUG.
Oh, Steve, thank you for your time and your insight, and thank you for watching. That was Stephen Schoffstall, Director, ETF Product Management at Sprott Asset Management. I'm Erin Real, and thank you for watching Asset TV.